Well, good morning, everyone. I am Carolyn from Midwest Manufacturers Association, and I'm happy to have you sign up and join us here today. We do have a manufacturing industry webinar, Succession Planning 101, How to Value a Company. Our presenters are Nick Dunnom. He's a business broker at Sunbelt Business Advisors, and Chris Jones, co-owner CEO at True North Mergers and Acquisitions. We are going to have opportunities within this presentation to stop and ask questions, and you can do that via chat, or if you want to turn on your microphone, but we'll be stopping from time to time. And also wanted to let you know I am recording this, and we will share it to our YouTube channel, and I will also have that available and email that to all of our guests. So, all right, at this point then, I'm going to turn it over to Nick and Chris, and here you go.
Thanks, Carolyn. And I'll just make sure I've got control of this. There we go. Okay, go ahead, Chris.
Well, thanks for having us, and welcome to How to Value Manufacturing and Fabrication Companies webinar. We love manufacturing. We do a lot of transactions in manufacturing. It's an exciting time to be in manufacturing, as we're all watching the news and all the stuff going on with tariffs, depending on what your inputs are, and all the discussions about reshoring. We won't be getting political today or diving into tariffs, but we will hopefully, when you walk out of here, give you a better understanding, a fundamental understanding of how to value a manufacturing or fabrication company or related, whether you're looking to grow the value of yours, whether looking to sell your company right now, or whether maybe you're looking to buy and make a strategic add-on to your business. We want to equip you with that information. Our core values: help people first and success will follow. Education like this and supporting organizations and associations like yours are a big part of that value. So that's why we're investing this time. So Nick, you're driving, right? All right. Good anticipation there. Thank you.
Yep.
So you heard the word Sunbelt. You heard the name Sunbelt at the beginning. Sunbelt Business Advisors. That's our brand, the part of our company or division that handles companies under 10 million in revenue. True North Mergers and Acquisitions, same ownership. Myself and my business partner, and then our 49 deal makers we have here and our support staff in Minnesota. True North, the True North division or M&A division focuses on companies with 10 to 150 million in revenue. The left side, what you see on your screen, we affectionately refer to as Main Street. The right side we refer to as M&A, or if you want to get technical, lower middle market mergers and acquisitions. Really, the big difference is not just size, but who the likely buyer is. On Main Street, the likely buyer is a high net worth individual, an owner operator, maybe a smaller strategic in the market who's looking to expand their capabilities. Whereas the M&A side, the right side, 10 to 150 million in revenue, you're much more likely to attract a private equity group or a larger strategic buyer, someone from out of state, maybe even somebody across the country or out of the country who's looking to enter your market, add your capabilities, etc. The reason we explain this at the beginning of these webinars is that it can really affect some of the information we're going to present. We'll touch on both. A lot of things we talk about today are fundamentals. We're not going to do a deep dive on the M&A side. There's more there. So if you're one of the 10% of companies in Minnesota that's in that upper revenue range, there's a lot more information to give you, but this will give you some fundamentals. And quick brag, we're nationally recognized and by our industry association as the #1 business brokerage firm in the country for total number of businesses sold, total dollars sold. The only reason that's relevant to you is we've done a lot of transactions. So we're sharing information that we've learned and distilling it down for you today. You give me the next slide, Nick. Okay. So I don't know if I need to convince you to be here today because you're already here, but why should business owners know what their business is worth? Well, because you're busy running your company. Why do you need to know this? You got a lot more important things that you could be working on. I want to just touch on that real quick of why it matters. If I get the next slide, please. Okay. We're going to cover, Nick will talk about this slide in a second. But I want to cover the why it matters at the top. I suspect we recently talked about this in our podcast called Grow or Go, which is a good listen for anybody who wants to learn more about this topic. But I suspect if you're a business owner on the call today, if you're a business owner like me, and you own the real estate, you know what your real estate's worth. If you own stocks, you can peek at your phone and you know what your stocks are worth today, maybe painfully based on what's going on in the market, but you're able to track that on your phone. If you own precious metals, you know what those are worth. You almost certainly know if you own a home, what your residential property is worth, or if you own a cabin. So the fact that you may not really know what your business is worth, not what you think it's worth or what you talk to a friend about who sold their business, but you have a fundamental understanding of what your business is worth and how to grow that value. To me, it's crazy if somebody doesn't know that, especially given that most business owners have 80% plus their net worth tied up in their business. So it's probably a big part of your future liquidity. And even if you're never going to sell, if you're going to die with your boots on in your business, it's good for the next generation. If it's going to be a family member or a key employee, to understand the value of that business. And I would argue it's kind of like going in for your annual checkup. If you don't have a baseline understanding of what a healthy value looks like, it's hard to tell if the value is going up or down. So that's why we think it matters. And Nick, if you want to quickly touch on the agenda, the full agenda.
Yeah, absolutely. Thanks, Chris. So again, my name is Nick Dunnom with Sunbelt and True North here. And to Chris's point on why this matters so much, right, is like Chris said, for a typical small business owner, a lot of their net worth is going to be tied up into the business. Our typical client is a founder, a family-owned company who's either going to transition this to the next generation, maybe sell it to an internal buyer, or make their exit. And in each one of those scenarios, they're really going to get one shot at doing this. So understanding and having an up-to-date idea of what their company is worth is why that's so important. And that's why we're here today, is to educate you, whether you are an owner or somebody that services and works with owners. So what's on the rest of the agenda for today? We're going to talk about what's being valued and why. And we're going to discuss more so the quantity side, but there's two sides to the same coin when we're valuing a company that we need to address. Okay, the first is quantity, and that is the hard data, the black and white, the numbers of your business to kind of figure out what is the average value for a company like mine, right? And then we'll take a look at a little bit surface level today on the quality side of that coin. But we'll do more of a deep dive into that topic in part 2 coming up on the 14th of May next month. So love to see all of you back for that. And that's going to have more of the value drivers into that category, that quality side of things. Okay? And as owners, when we're talking about our exit, no matter who that's to, and when that time frame is, whether it's just a couple years out or perhaps even a decade, you've got some runway in front of you. It's a good idea to start shifting our focus and looking at things through the eyes of the buyer, okay, which is going to be the beholder in this situation when we are making our exit as owners, okay? And what they're looking for risk and they're looking for growth, okay? And we'll also discuss the 3 key considerations that as owners we should be considering when exiting our business. And those are going to be price, terms, and taxes, kind of the 3 legs of a 3-legged stool. And like Carolyn said too in the beginning, we'll have plenty of time for Q&A both during and after this presentation. So as Chris and I kind of switch off topic to topic here, we'll circle back with Carolyn to see if there's any questions that you all have entered into the chat box. We can address those. Otherwise, plenty of time for that at the end of the presentation as well. Okay. So let's get into it. When we're valuing a company, okay, the first question is how, right? How do I value a company? Well, there's dozens of methods out there that you can use to value a company, maybe hundreds, right? But the 3 most common ones that you're going to come across The first major method will be the cost method, right? What is this stuff worth? The tangibles in my business. Right? The second major method, being the market method, uses industry rules of thumb. And the final major method is the income method, which is going to be some measurement of current or projected future earnings. Okay. And because the vast majority of actual business buyers will use this income, that's what we're going to focus on today. It is the most common method in the marketplace. I'm not claiming it's the only method, okay, but because I would say 99% of Main Street deals, if we're talking about Sunbelt and True North, 99% of Main Street deals and most M&A deals are sold this way. That's what we're going to focus on today, is using the income method evaluation. Yeah.
I will just add a little color commentary if I can, Nick.
Yeah, go ahead.
Totally agree with that. We're obviously talking to an audience that tends to have asset-heavy businesses. So although we're not going to spend a lot of time talking about the cost approach or the asset approach to value, that certainly factors into value in manufacturing companies. But at the end of the day, because we have this conversation a lot with manufacturing companies, trucking companies, others that are heavy in assets. At the end of the day, do the assets add value? Yes. But what do most buyers actually want in the marketplace? If they're buying a healthy company, they want future earnings. They're buying the future. So they put most of the weight on the current or future ability of the business to generate EBITDA, discretionary cash flow, future profit, whatever you want to call it, to generate a return. So the assets are just one factor, but they're really focusing on future revenue and earnings. That's why we're going to focus there.
Yeah, that's exactly right. I mean, and that's kind of the caveat to this, right? Is if we're using the income method of valuation, that is not the appropriate valuation for, say, an emerging business or a startup company, right? Or a company that's in distress. So for the sake of today's conversation presentation, let's assume a mature company that's been in business for a number of years. They're profitable and they're going to either transition it to the next generation, sell to an internal buyer, or make their exit, while we're being conscious of both market trends and how the assets, the FF&E of the companies, pin up against that valuation as well.
Yeah, well said.
If there's any questions about the different valuation methods or the income method and valuation, again, just a reminder, type those into the chat box and we'll circle back at the end of each topic that we cover here. And I'm going to sound a little bit repetitive, maybe redundant, using that term income method evaluation, but that's intentional, right? Because when we're using the income method evaluation, there's a lot of things that are included in that type of evaluation, right? You have tangible assets like equipment, inventory, oftentimes there's real estate, and you also have a lot of intangible assets in a business, right? And those are going to be your customers, your employees, vendor relationships, any type of ongoing contracts or repeat revenue, capabilities, technology, IP, systems and processes, the whole thing, right? Basically, everything within your company necessary, both tangible and intangible, to produce that profit or the income that we're going to use as the basis for evaluation is included in the valuation. Okay. And when we're talking about intangible assets, it's easy to understand and wrap our minds around the tangibles within our business. Again, we've got inventory, we've got equipment, we've got facilities, right? Maybe machines, stuff like that. This is a good idea of some of the categories within that intangible asset diagram. And I do have your contact information from Carolyn. And so don't worry about trying to write all of this stuff down or snap a picture. I will email each one of you a copy of this, kind of a self-assessment worksheet on how to do a value driver assessment. If you have any questions, you can follow up with me via email, give me a phone call, and we can kind of talk through this as well.
Yeah, if you want to have fun when you do that exercise, if you have business partners, have them do it, or have a key department person do it. Because it's not, we obviously want to, maybe not within the context of telling you you're thinking about selling the company if you are, but have your spouse do it, have your business partner do it, have a key person do it, and then compare answers. It can be very revealing These value drivers are about making the business better. It's not necessarily just about a sale, right? So, you want your earnings up top line, regardless of whether you're ever going to sell the company or not. But ranking things like industry strength, customer concentration, contractual revenue visibility, financial documentation, strength of your employees and management or operating systems can lead to some very interesting discussions, and no comparison to see kind of a SWOT analysis, how strong, weak you are in these areas, and can help you improve your company. Even if you're never going to sell, this exercise can help you make your company better.
Yeah, definitely. And so again, we'll touch a little kind of surface level on these value drivers in today's presentation. We will do a really deep dive into these value drivers in part 2 after we recap part 1 for people that are joining for the first time. But so if you're here today, take this home with you, do that self-assessment, whether it's just you or with your partners. Sometimes it can be kind of daunting. Oftentimes it's not uncommon to sit down and go through this assessment with owners, and they find that they're lining up on the left side of this worksheet, mostly if not entirely, right? And that can be kind of overwhelming. In part 2, we'll have some case studies for this presentation today as well, but in part 2, we'll have some case studies on how effective working through these value drivers can not just increase the value of your business, but make it more efficient and profitable as well. So when we're talking about the value of the company, though, and all of this stuff being included, the real question that we want to start asking ourselves is, what is the value to the buyer, right? And the answer is that it depends, right? It depends on what the buyer's needs are, right? Most buyers are interested in the immediate earnings of the company, right? Again, using that income method of valuation, right? We want to put that income in its best light, right? And then depending on who the buyer is and what their needs are, they're going to assess a certain amount of value to each one of these categories and then some, right? They might be interested in diversifying their customer base. If they are a strategic buyer, perhaps you offer something synergistic to their current capabilities that they're after. Maybe you solve a problem for them. If you're working with a financial buyer, meaning they don't own a company like yours, they might be a first-time buyer, a high net worth individual, maybe a corporate refugee type of buyer. They're going to find value in each one of these categories, right? They're going to find value in your earnings, your customers, your staff, your products, your company history, basically the entire operating enterprise they're going to find value in. Go ahead, Chris.
Okay, thank you. I think we touch on this later, but just to give a quick example of strategic buyers, we were part of a recent transaction of Design Ready Controls acquiring Fabrico. DRC is a control panel manufacturer that had been outsourcing their metal fabrication. They decided they wanted to bring that in-house to have more control over that, and acquired Fabrico to add that capability. So that may be an example where if you're on this call and you're looking to add strategic capabilities, you might be considering this. Or if you're thinking about a sale, who needs the capabilities you have? We'll touch on this a little bit later, but if I could give you like one of the most important things to come on this call with, for if you're considering a future sale or even a purchase, typically your most obvious buyer is the one who's going to pay the least. The person who does what you do in your market, it generates the least accretive value. So you think about a competitor, like maybe they've even approached you and said, well, if you want to sell someday, we're growing, we'd like to buy you. They might be a motivated buyer. They might be a quote unquote good buyer that way, but they almost certainly aren't the one who's going to pay the highest price. Why? Because you're fighting over the same customers already. They already have a brand. They're already in the market. So what's accretive is, frankly, any customers you have that they don't already have. So they'll often pay less for that reason. Not always, but often they'll pay less. Versus if you have customers they don't have, you serve a market they don't have, you have capabilities they don't have, all those things are accretive and are worth more in strategic value. Okay. Sometimes I like to go off script. Nick's used to it, but I'm trying to provide good education for everybody. So EBITDA and seller's discretionary earnings are just two terms for really the same thing, earning power of a business on a pre-tax basis. First, again, let me just emphasize buyers are usually most often looking to buy to gain future income, but they will focus on past earnings as a proxy or a major indicator of future performance. EBITDA, you're guessing you're all familiar with it. Earnings of the business on a before interest, before taxes, before depreciation charges, before amortization is a very common measurement tool. SDE is basically the same thing. It's EBITDA, but for smaller companies, most of those under 10 million in revenue, in many cases, we're adding back the owner's compensation to that number as well. So it's EBITDA plus one owner's compensation. Now, if there's 4 of you who own the company and you're all active in the company, we're not adding back all 4 of you. Right? We're adding back one because we're assuming, and when we use SDE, that an owner operator is going to buy the company and replace that one person. They're going to be an active hands-on owner operator. So, an intermediary, a broker like Nick can help you determine whether EBITDA or SDE is more appropriate for your business. But just remember for now, it's a measurement of the earning power of your business on a pre-tax basis. Okay. The problem with that is, I'm not saying I do this as a business owner, but over the last 20 years, I've met lots of business owners who don't like to pay taxes. I love paying taxes. I guess it's my patriotic duty to do that. But in all seriousness, none of us like it. We're doing everything we can with our CPAs, our accountants, to get as much depreciation that we can accelerate, other charges that we can charge the business, usually to reduce taxable income. If you do that for 20 years, and then when you go to sell, it's a problem. Because a buyer's going to look back 3 to 5 years, and you've been probably writing your tax returns to to lower the tax bill as much as possible. And now you have to explain that to a buyer. Okay. So that's okay. You can do it, but recasting is necessary to do that. And what we're looking to do is reposition the financials to highlight any benefits to the owner, your car, your 401k, owner's life, anything that are fully discretionary to you, or one-time legal or consulting expenses. We're also looking to normalize things. I recently looked at a construction company that was doing about 4 million in EBITDA. Was doing about 4 million in net income, but we were able to add back 2 million in depreciation because they bought a ton of equipment that last year, and they weren't going to need to make those big of purchases for a while. You could argue they overbought. We were able to normalize that. So now we're talking about selling a 6 million EBITDA number versus a 4 million. Here's the key concept. Every dollar of EBITDA SDE generally means multiple dollars to your price. So this recasting step's really important. Otherwise, you can leave significant money on the table. Here's an example. Usually they're more dramatic than this, frankly, but this company has 800,000 in net income. We added back 100,000 in interest. We added back 100,000 in depreciation. There were no amortization charges. It wasn't a C Corp, so we didn't have any taxes to add back. We have an EBITDA of $1 million. If, depending what the industry is, we determined the appropriate multiple was 4 times, we'd assign a $4 million price, probable selling price to this company. Now, usually what you see here is 10 more adjustments for discretionary items that the owner might be running through the business. And that's fine. And it might be hundreds of thousands of dollars, but we have to be able to connect the dots for the buyer to understand that if there's any non-operating expenses in that business, that they can feel confident that the adjustments are legit, if that makes sense. Okay. So before I get to the next slide, just kind of a big word of caution. I've done this presentation to 400 CPAs before, a room full of financial planners, manufacturers, service companies, retailers, distributors, you name it. almost always the big question is, oh, okay, yeah, I get this EBITDA stuff. I know what my earnings are. What's my company worth? Or what are the multiples in my industry? So we're going to share those with you. Nick can also send you a follow-up. But remember what Nick said about value drivers. Well, we're going to show you our averages here, which means it's the average, or in some cases the middle. It's a blended average, and there's a lot of danger in that number. I have a dry sense of humor, so this cartoon's in this deck. But if you read the sign, it says a flaw of averages. This body of water is 3 feet deep, but then we see in one area it was much deeper, and created an issue for this gentleman here. What we're trying to say is using averages are dangerous. They can put you in the right neighborhood, but understanding whether your business deserves a premium above the average or a discount from the average, and doing a sober self-assessment of your company is really important. Not surprisingly, most business owners think their business is above average, right? But we're going to give you some tools in these sessions to understand if it really is and how it might compare, and what it might mean to your value, and what it might mean for you to be able to grow the value of your company. So if you're looking at the first line, you'll see that across the left, we have industry, and across the top, we have the amount of EBITDA for these companies, with the first column being under $1 million, up to 999,000. So we're talking manufacturing. So let's look at that first line. And for under $1 million, the average multiple for manufacturing, the average is 4.3. Now, that means some went higher and some went lower. So some might be at 2 or 3, some might have been at 4, 5, or 6, depending, but that's the average. And this is a report from that Pepperdine's been putting out for decades on multiples. Now, you'll notice, interestingly, as EBITDA goes up over $1 million, we see a leap to a 5.5 average. And then if you go all the way over to over 10 million in EBITDA, we see another leap to 7 times. Over 50 million EBITDA, 7.5. That's called a size premium. The reason that's there is bigger companies tend to have less risk, meaning if they lose John Deere, if they lose somebody else they're fabricating for or manufacturing for, or they lose another OEM manufacturer in auto parts or mining or whatever industries you're serving, if they lose a key customer, those multiples, the business is likely less impacted because they're bigger, if that makes sense to everybody. So that's called a size premium. It also is kind of a rarity thing. And it also is an assumption that buyers make that as the company gets bigger and generates more EBITDA, it's probably punched through some problems. It's to figure out how to be less owner-centric. It's figured out how to develop a management team successfully, which is not easy to do. It's figured out how to diversify, those kind of things. So, Nick, I think this is my slide too, right?
Yeah, go ahead.
Yeah. So this is how I remember it, folks, and I've been doing this for a long time. Imagine this is a 10-carat diamond, okay? We know how big it is. We know quantitatively how big it is. So what's it worth? Anybody want to take a guess in the chat? I don't know if we have any gemologists or, jewelry experts on the call, but we're not giving away any prizes I know about. But anybody want to take a guess at what a 10-carat diamond's worth? Nick, how about you? What do you think?
Let's see here. I'm gonna open up the chat, see if anybody's typing in here. Roderick says depends on color, quality, clarity.
Exactly. So Roderick nailed it. So businesses are very similar. We really can't answer that question until we know the qualitative questions, right? The color, the cut, the quality, as Roderick so correctly said. Nick, you and I did look this up the other day. I can't remember what the range was.
What I do know is that the average value of a 10-carat diamond is about 450,000, but the value range is going to be about 100,000 up to 1.1 million. So
yeah. So if we had a higher quality diamond, and we use the average of 400 and some thousand, we could accidentally leave money on the table. Or if we had an inferior diamond and we were demanding the average price of 400,000, we might not know that we might be off market in what we're asking for, right? So how do you find that stuff out? How do you determine the quality of your diamond or your business? We'll talk about that next.
Right. And so what we just talked about is, if we go back to the beginning of the presentation and talking about that, the quantity and the qualitative side of that coin to assess, what we just talked about was the quantity side, right, of how to value a company, right? If it has X amount of EBITDA, we're going to apply a multiple and come up with a price. But we also said, what about averages? It's risky, it's dangerous to use because that's just the middle, right? And so hopefully after today, because what value drivers are going to do is they're either going to move that, now that we have our starting point of value, I have a manufacturing or fabrication company or whatever company, it's got this much EBITDA, here's my median starting point. And then depending on how we do on our value drivers assessment, that's either going to move that needle down in value or hopefully up in value, right? And so what multiples are going to be driven up by are growing industries, proprietary products, meaning barriers to entry, essentially how hard is it for somebody to compete with you and what you're doing, right? Lack of owner centricity, like Chris was talking about, as companies grow in size, they become less risky. And oftentimes that includes having things like management teams, different divisions that allow the owner to, although not being physically and presently at that business at the time, can still have that business operating. They can go on vacation and not have their phone ring for a week. Right? So where conversely, my business, very owner centric, right? If I go on vacation, I'm bringing my laptop and my cell phone with me, and I might have my toes in the sand, but I've got my phone in my hand, right? Things that are going to be driving multiples down, inconsistent earnings or lumpy project-based earnings, high sense of owner centricity, right? Low barriers to entry. A good example, right? And I'm not picking on restaurants in particular, but restaurants will typically earn a lower multiple because there's very few barriers to entry, right? Doesn't mean that it's easy. It's just there aren't any big regulatory barriers. You don't have to have any patents, a bunch of equipment and machinery like you do in manufacturing and fabrication. Whereas conversely, if we were to open up a brand new manufacturing company here in the Midwest, right, we're going to need a certain type of space and facility, equipment, oftentimes expensive, right? We're going to need machinists and fabricators, maybe even engineers, patents, right? And that's why manufacturing generally earns a healthy multiple, right? And so here are some value drivers that are going to affect the value of a business up and down, right? You've got customers, you've got your industries served in your end markets, you've got suppliers, you've got competitors, and you've got management and financials, right? And again, shifting our perspective to the eyes of a buyer, right? What buyers are doing is they're looking for two things. They're looking for risk and they're looking for growth opportunity, right? They want to manage their investment risk and they want to, at a minimum, be able to replicate what you're doing. But in a better world, how do you drive into what it's currently doing to increase and grow that company, right? They're looking for the risk. Less risk, higher price. More growth opportunities, higher price. And so as business owners, if we can de-risk our business, what we will do is we will sell it for more money. Okay, it's going to increase our chances of attracting multiple buyers and demand for our business. And in doing so, we'll have a higher liquidity event when we have this wealth exit, right? And we're going to net more from the sale of our business to fund the next chapter of our lives more comfortably. Okay. And we'll do a much deeper dive into these value drivers again in part 2. So bring those self-assessments back with you. But here's a surface level look at customer concentration, which is going to fall under customers for a value driver. Okay. Now, if your top 3 customers make up 90% of the revenue, okay, it's going to earn a lower multiple. Okay. there's going to be a discount because of risk and low growth opportunity. Okay. Whereas conversely, if the top 10 customers, right, it's reasonable to say that in some industries, you're going to have your best customers. And the metric we find most acceptable is if your top 10 customers are less than 50% of revenue, that's moderate risk, moderate growth. It's really not going to move that needle a whole lot on this opportunity. But if a business owner can diversify their customer base so that no customer holds more than 5% of revenue, okay, that is viewed as a low risk, really high growth opportunity. Okay, buyers are going to be very excited about this, and it's going to earn a much higher multiple. Okay, for the reasons that Chris just talked about a little bit ago, and I'll give you an example. Right, last year we were working with a client, and it was a great company and very attractive. We went to market. We had 160 requests for information in the first month or two. Really good company. Their best customer checked all the boxes for what you would want out of a really good customer. Right? It's an international. It's a Fortune 100, and it's very profitable. Right? After the dust settles, they earn about a 30% net profit from this one customer, right? Which throws about $1 million to the bottom line for this company that we're working with. The only issue is that this client holds over 50% of revenue and profit for our client. Okay, so we're going through the process, and we're having buyer-seller meetings, and we're just about to start collecting offers when I get a phone call from the client. Nick, I didn't sleep last night. For the first time in 30 years, we just got fired from our best customer. Is this going to affect the sale of my company? I laugh. They're very, very unfortunate, but what do you guys think, right? That's very risky when you have a very high customer concentration with one customer. Okay. Again, if you shift that and you can raise the bottom with your other customers to diversify that, right? That's going to be much less risk and high growth. I mean, if you just look at the math and don't attach yourselves to that 4x, 5x, and 6x at the bottom, that's just for visual understandings. But if you look at the math of what de-risking can do, many, many multiples of dollars that can be gained. If we go back to that $1 million EBITDA example that Chris walked through, that example on how to recast, okay, you're looking at a baseline $5 million company. If your company has a lot of risk because of the value driver assessment in your company, that might be discounted down to 4 million. Whereas if you can work from the left side, that risky side, to the less risky high growth opportunity side, right, there could be potentially a $2 million swing in that one company, right? And again, that's just a surface level look at some of the more in-depth categories that we'll do a deep dive into in part one here. Being conscious of time, I do want to get to the end of this here in the next 5 to 10 minutes, so we have time for conversation and questions. But here's a little bit of a look at deep dive on customers that we'll go through in depth. Again, industries served and end markets, right? Where are we selling into? What industries are we serving? Our suppliers, you'll see very similar metrics to customers, right? You're going to see supplier concentration on there, any contracts in place, that sort of thing. We're going to look at competitors and our competition, barriers to entry, and management and financials, okay? And we'll do, again, a deep dive of that in part two. So, Chris, if you want to pick up from here.
Yeah, this is one of my favorite slides. Basically, I'm very passionate about making sure business owners don't settle for one buyer. And in this particular case, we had 8 offers on this business. You should be seeing this slide says quiet auction case study. And this is a larger transaction, but the same dynamic can play out on good-sized Main Street companies. These numbers are all in millions, and the owner was targeting 80 to 100 million for the business, and had been approached many times with folks interested in buying it, as is typical as companies get larger. We ran what we call the quiet auction for the M&A side of our business, and we set a date we wrote a nice profile of the business that told its story, not just about numbers, but about the qualitative factors, right? Here's the color and quality of this diamond. And from a growth aspect, here's how the diamond's going to grow, right? Your diamond's going to become more valuable. So we wrote the growth story. We targeted buyers, and we set a date for them all to submit their offers. The blue bar is the first offer, and you can see the offers came in between 63 million up to 115 million, which is great. Right away gives our seller options. Then we go back to the buyers, the ones that we felt were serious and well qualified, and say, hey, we appreciate your offers. We'd like to get your final and best. We have these questions. Here's some more information. We'd like to get your final and best offer in whatever our date was, probably 2 weeks. The blue is the amount that buyers added, and then you'll see on the right side, one buyer came in late in the game. Now, sometimes when we present this slide, clients are surprised to know, potential clients are surprised to find out that our client did not accept the $140 million offer. Why? Because the quality of that buyer, right? Because there's quantity and quality of buyers too. The quality of that buyer was not as good as we would have liked. The probability that they would close on that $140 million offer was not as high as we'd like. So on the surface, the price seemed good, but the probability to close, we didn't have a lot of confidence in. Ultimately, we went to the folks you see in the middle, who originally wrote an offer for 90 million, and then they wrote a new offer for 105 million, and we said, our client likes you the best. We think you're a great fit. They'd like to do a deal with you, but you're not the highest offer. So what's the best you could do? They added another 15 million to their offer, and we ended up selling the company for 120 million, right? Keep in mind, our client would have sold for 80 to 100. It was kind of their target, right? But when we go to market with M&A deals like this, we do not put a price on the business. And if any of you have a larger company, if you're past 10 million in revenue, if you're over $1 million to 2 million in EBITDA, I would highly encourage you not to ever give buyers a price, because you don't know how this dynamic might play out. Now, interestingly, we recently sold a Main Street distributor, and for hot categories like that, we're seeing a similar dynamic play out. We had, I think, 11 offers, Nick, on that deal, sold for over full price. So the idea being this, we want to run a quiet auction. In that one, we had a price, but some buyers, because it got a lot of attention, ended up writing an offer over full price. And I just hate to see people with good profitable businesses not pursue just one buyer. It's like if you had a beautiful classic car and you went to an auction and you only invited one person to the auction and you hope they were the one that was going to pay the most. It's just, what are the odds? It's like, well, I really like your car. Well, that's fine. But a lot of people like this beautiful classic car, this diamond, and some other folks might pay more for this business. So let's give you options and control in the process. So I'll shut up, Nick. You know I could go on this slide forever. So
Yeah.
the other thing I want y'all to consider that I hinted at earlier is if your business is at the middle of these concentric circles, right? You're there in the middle. The folks that are the closest to you, your employees and your competitors, they could be the right buyer for your business. In fact, a survey that we did back in 2023 with 400 folks, business owners in Minnesota, said 57% of you would prefer to sell to an internal candidate, family member, key employee, etc. The issue we often see there is familiarity breeds contempt. And the closer, certainly with competitors, the closer they are to the business, the less accretive value they see. Usually the less, they might be the buyer, but they'll offer less. Also, there's this tremendous assumption that the employee wants to become an owner. And if you have not socialized that, if you have not trained them, if you've not found out if they have entrepreneurial DNA, if you haven't found out that they want to sign a personal guarantee and take out a loan or sign on the line for a lease or buy that new $500,000 piece of equipment, you may not understand whether they're family or a key employee, if that's a risk they're really prepared to take. As you move away from the company, high net worth individuals will pay more. Small investor groups typically will pay even more. Private equity groups will pay more. The buyers who typically pay the most are strategic buyers, where they're getting income from the business, and you have something they don't. You're solving a problem for them, like a capability or a presence in a market. I hope that makes sense.
Did you want to touch on this again?
Yeah, but I think I hit it. There's an example of,
Yeah.
DRC wanted to buy metal fabrication capabilities as part of their growth strategy. And we were an M&A advisor on this transaction. And they were able to successfully do that. You can Google this transaction if you're curious. Design Rate Control is a good sized company, but they wanted to add a capability. And they were willing to pay a healthy multiple that maybe a private equity group wouldn't have paid, because private equity groups are usually looking to flip their transactions in 5 to 7 years. They're not buy and hold, so they're like real estate investors that way. They have a limited window to get their return, so there's kind of an artificial cap. Well, I'm not knocking private equity groups, say they can be great buyers, but they usually can't afford to pay as much as a strategic.
Yeah, I think they're more focused specifically on the financial performance, like you said, than the long-term hold and implement
Yep.
the strategic
Yeah.
plan.
Yeah, they're often not buy and hold. Correct.
Yeah. So, okay, we're going to be wrapping up here pretty soon, actually, I think after this slide. So, last thing that I wanted to talk to you guys about was price and terms, okay, and the inherent tax burdens that are the result of these things. Now, I'm going to preface this by saying, I'm not an accountant or a financial advisor, so I'm not giving any tax or financial advice. Not going to fiduciary myself in that sense, right? We're just going to have a conversation. But I think one of the other big misses for business owners, okay, is that they over focus on the price. Okay, they want to know what their business is worth, and of all of these other types of considerations that you might be able to negotiate and implement into deal structure, right? You've got cash, you've got promissory notes, earnouts, consulting agreements, royalties, and if there's real estate involved, leases and rent, right? Which one of these do most business owners focus on the most? Right, it's cash, right? Because it's immediate and it's tangible, right? It's right now and you can put it in my pocket, right? The problem with cash, of course, is that, in whatever year you do a deal that is all cash in, the other person that's going to be at that closing table with their invisible handout, Uncle Sam, right? Pay me. So one of the things I want to talk to you guys about before we wrap up here is seller financing for just a minute, okay? And when I do these presentations or I'm meeting with business owners individually and I bring up seller financing, I can almost, I can see the change in perception in the room. I can almost see the shoulders kind of sloop down a little bit, a couple inches, and I can almost tangibly feel the temperature in the room drop a couple of degrees because the initial reaction is to recoil from risk, okay? They're not interested, not even talking about it, and I will bring it up early and often because as we go through evaluation, right, the presumable tax burden, we recast the balance sheet to figure out, okay, at the end of the day, because in most acquisitions, it's going to be cash-free, debt-free, free of liens and encumbrances, meaning that an owner keeps cash, accounts receivable, but they also have to take care of accounts payable and other liabilities, right? We look at their presumable tax burden and they think that they're never going to be able to sell because of that fact, right? Seller financing is not bad. We do it all the time. In fact, I'm in the middle of one right now that is 100% seller financing. I have yet to do a deal that is 100% bank financed. I just haven't done it yet. And I'll give you guys just a kind of a quick numbers exercise, right? Because I think, especially, I mean, again, we're not here to talk politics or tariffs or besides Chris and I don't have a crystal ball that can foresee the future anyways, right? But as inflation and bank rates, comparatively speaking to, even just a few years remain fairly high, kind of squeezing business values, creative solutions to deal structures are going to be the way to go for another few years at least. And the reason being, right, is the higher the rates are, the more the value of a business inherently needs to be compressed to allow for debt service new owner returns, that sort of stuff. Not always, but a lot of the time, right? So let's say, to use the $1 million in EBITDA example we had earlier in the slide, okay, let's say ABC company, or let's even make it easier. Let's just say we've got a $1 million company, okay, ABC company, right? And they want to sell their business. And they're completely opposed to seller financing, but we find a very qualified buyer that wants to put a third down in the form of a down payment, okay? So they're getting, let's say, $300,000 upfront in a down payment, okay? And they're going to seller finance the remaining $700 or $700,000. Owner gets to play bank and make some interest. And really what that interest is going to do is, and if anybody has a loan or a loan calculator app on their phone, they can do this as well. I just did earlier today, so I'll just pull it right up. But what that interest is going to do is effectively increase their total net at the end of the day by a couple $100,000. There it is, $231,226 to be exact, based on where current market trends are right now for interest gained on promissory notes like that. Okay. Now I've heard it before, Nick. I would never do seller financing. It's way too risky. Okay. Well, would you do it for a company or a corporation that you respect in your industry who wants to enter your market? Okay. What if they're willing to put up a corporate guarantee or a personal guarantee, right? Or perhaps the buyer finds it extremely attractive that you're willing to do seller financing because that's favorable to them. They don't have to deal with banks, and it shows that you're confident in the future success of your company. So you're in a premium on the sale price of your business. Maybe instead of $1 million, it's 1.25, right? So as a seller, you get the third down, you get the increase in the sale price of the business, you kind of fan out that income over the course of the next, say 3 to 7 years, right before that note balloons. You get the interest gain. For all of those reasons, seller financing can be a very valuable tool for either part or all of a transaction price. As a small business owner myself, I would strongly consider it, seller financing my business if I didn't need all the money upfront from the transaction to either fund the next chapter of my life or for the next investment or whatever it is. So,
yeah, to give everybody some context, there's plenty of cash in the marketplace to get cashed out if you want to, but you are going to miss out on the interest earnings opportunity and pay taxes sooner. The Market Pulse report that comes out every quarter, last quarter, I think it indicated the average amount of cash at closing was 80 to 85%, and the balance is seller financing. So there's still tons of cash in the marketplace. But if you get a really strong buyer, and if you're trying to mitigate taxes, this can really make a difference in post-closing liquidity. And there's a reason the banks like interest, right? So if you find a really strong buyer who's properly secured and collateralized, it can really pay off well to finance seller finance a portion of the price. But if you need all cash, or you got debt to pay off, or you got the next big investment you're going to make, there's plenty of cash in the marketplace. So here's what we covered, just as a little reminder, and we'll open it up for any questions.
Yeah, so let's recap. Make sure you define what's being sold, right? Using that income method evaluation, right? What's included in that, your tangible, intangible assets. Measure your EBITDA or your SDE, whichever one is appropriate for your situation, and then understand your typical multiples, right? We just shared the slide with you. You guys understand a pretty good starting point, right, for manufacturing and fabrication. But to go deeper, you need to understand your value drivers. Look for the risk and the growth in your business to determine whether a premium or a discount is going to be applied to your company. And then understand the buyer types and how the sales process works. And how those are going to impact price, and don't over focus on the price. Okay, terms and taxes are also a huge factor in what this liquidity event is going to mean for you in the rest of your life. So with that, yeah, let's open this up to questions and comments, concerns, and conversation. So
The first question is, they say it's a great presentation. Are we getting the recording of this presentation? And the answer to that is yes. I will upload that here and get it out to you in the next, probably this afternoon.
Great, thanks, Carolyn. Anything else?
Another comment, great presentation, very insightful.
Thank you.
Thank you for the feedback. And sometimes the questions we get, folks want to ask, one-on-one. They might be specific to your company. So obviously Nick's available to help you with those questions. We are happy to answer those things. We have a lot of conversations with folks before this is a big decision for business owners to make. So we're used to having those introductory conversations all the time.
Yep, that's right. Yeah, thanks everybody for coming. My contact information is right there. I'll send an email out to all of you with that value driver self-assessment PDF in there. Do that. Hope to see you guys on May 14th for part 2, where we learn how to maximize the value of manufacturing and fabrication companies. So thanks again, everybody.
All right. Thanks, Nick and Chris, for joining us and sharing your expertise. We will see you next month.
Thanks for having us.
You bet.
All right.
Thanks.
Have a good day, everyone.